Good morning, ladies and gentlemen. On this wonderful Tuesday, let's look at the way markets are functioning. Today is the day for IT stocks to rise and shine. The IT index is up 560 points, 1.5% at 38,229, while the broader markets continue to be flat. You have the CNX IT index showing great promise in trade today. This is the highest since 28th of February, and it has overcome its 365-day moving average. So the broader markets are consolidating above 25,100 as far as the Nifty is concerned. Let's just dip a little bit lower into the markets. About 1,566 stocks are in the green versus 900 in the red. You have the IT index, just as I have pointed out, the metals index, the energy index in top shape. These are the three top gainers. The Nifty midcap select, small cap 100 and midcap 100 index are also in the green. Stocks that are hitting all-time highs, some unusual names, makers of oil and gas pipes, Wellcorp, 989 for you, 3.6% higher. This is a fresh high. Defense counters, BEL, crossed the 4,400 rupee mark. You have a fresh rally on Manappuram Finance and Muthoot Finance. Fortis Hospital is also at a record high, and by and large the market is in good shape as far as sentiment is concerned. What we will do now is take a view in the market from Mr. Mayuresh Joshi, Head of Equity Research at William O'Neill Securities. Namaste Mayuresh ji, and a very warm welcome to you, sir. The rate cut by the RBI, in fact, more than anticipated, and the CRR cut of 100 basis points has sparked a rally. How do you see sentiment on Dalal Street? And at this point of time, is the risk on trade getting better and better?
Morning, Shel sir. No, absolutely. I think what has actually transpired with the RBI front-loading interest rate cuts and also giving the CRR cut has given a huge boost in terms of liquidity for the system as a whole. The second aspect, in terms of a cumulative effect of all these elements put together, means that historically, as we've seen this, that corporate earnings should inch up by at least 250 bips. Now, the expectation, Shel sir, last year of earnings growing at 14% on March.
Yeah, please continue, sir.
Sorry, I thought there was 7 tones. So the corporate earnings, which are expected to grow last year at 12 to 14%, obviously got marred for a whole host of reasons, including the liquidity crunch that the system was seeing, political elections, etc. But now with liquidity coming through, I think if the 250 bips expansion happens in corporate earnings, just because of leverage going down on balance sheets, growth capital being provided to a lot of sectors which are starved for liquidity, I think the micro corporate earnings grow by 250 bips, and where a base case scenario has been built at 10 to 12% growth, your base case itself grows to 12.5%, and therefore the range now moves back to 12.5 to 15%, which means that as corporate earnings pick up with a slew of rate cuts, expectations of consumption coming back, urban consumption for the tax cuts that have got announced, expectations of good monsoons leading us to believe rural consumption coming back. I think all the elements related to micro perspectives as far as corporate earnings or growth are concerned, very much on the card. So yeah, I think from a macro and a micro perspective, I think India might probably remain the best placed market in the world as we speak.
Okay, it's an interesting point that you mentioned, Mayuresh, that you see earnings upticking by 250 basis points across the board because of this rate cut, and of course, why shouldn't they? Cost of capital will go down, and credit growth will also expand. These are the hopes that are getting built into prices. Between Friday, when the credit policy was announced, and Monday, or maybe today, what are the changes that William O'Neill Securities has made in its model portfolio for India? Any additions and deletions?
So, Shalsar, I think what we've done largely over the last few weeks has been a constant scenario that we've built up. A couple of additions that we've done very recently, one from the healthcare space and our belief is again that earnings should probably hold up for hospitals as a space. And therefore, Fortis Healthcare is something that we've added to our model portfolios over the last few days. Our sense is that the numbers that Fortis had delivered for quarter four for FY25 largely should sustain into FY26 and FY27 based on two counts. One, I think the additions that they have done should start largely playing out. And these additions are playing out beautifully. I think the average revenue for operating bed for the addition that they've probably done in the Punjab Haryana belt, in the Chandigarh belt rather, are adding significantly as far as ARPOBs are concerned. And the new additions are happening in a very asset-light mode. And therefore, I think the operating beds that they're operating right now at 4,750, 2,000 odd beds expected to get added over the next 3 to 4 years. Incrementally, with increasing ARPOBs, might mean that the margins for the core hospital business at 20.4% should show significant signs of improvement. Our own sense is that over the next couple of years, the hospital margins, the core hospital margins, should be around 21 to 22 odd percent. The diagnostic business is doing equally well. They've done the Agilus acquisition because of which the debt equity levels have probably gone a tad bit higher. Nevertheless, I think the expectation in terms of the margins that the diagnostic business probably exhibit are very, very strong. So our own sense is that Fortis can do wonderfully well as far as earnings are concerned. And therefore, that's the latest addition that we've probably done in terms of our model portfolio plays.
Okay, that's wonderfully put, Mayuresh. A very precise and concise explanation as to why Fortis makes sense. And no surprise here, the stock is also at a record high, as are many other hospital stocks hovering around their previous peaks, including Apollo Hospital. So that's one change that you've made. How about real estate, Mayuresh? Very smart rallies we are seeing in Brigade Enterprises, Sobha Developers, Oberoi Realty, all these moving up because a 50 basis rate cut will obviously make either EMIs lesser or fresh loans cheaper. Within the real estate space, what is William O'Neill's top pick?
Well, Shalsar, I think we continue holding a stock like DLF in our global portfolios because our sense is the kind of pre-sales velocity that DLF has achieved over the past few quarters in terms of its residential offerings has been very well received. Let's not forget its commercial and the annuity part of the business, which is holding up really well. So this is one stock that we continue holding in our global portfolios. Obviously, we've probably recommended and taken these stocks at way lower levels. But one stock within the real estate core developer space that we are keeping on our radar is Prestige Estates. Our own sense is that the kind of ongoing projects that Prestige Estates has in its kitty as we speak is a significant one. And again, it's a mix of residential, commercial, as well as the retail mall space, which probably has a perfect hedge in one of the segments. If one of the segments starts probably showing some signs of stagnation, the upcoming projects are equally good as well. Around 88 million square feet of upcoming projects. A large part of that is residential. And again, within residential, I think the Mumbai launch that they have done is something which is picking up steam. And therefore, I think the kind of pre-sales velocity that the Mumbai launch for Prestige, the Nautilus project, has delivered so far. If it continues its pace, I think the over-dependence in terms of the Bengaluru market probably gets shielded to a certain extent. And therefore, I think growing markets like Mumbai, Hyderabad should compensate. When it comes to core accounting, the expectation in terms of free cash flows and cash from operations that can come through, which is a very integral part in terms of how real estate accounting is done. I think there is a significant portion that can get accrued over the next few years. And therefore, our own sense is that both in terms of the placement of the stock should be kept on your radar. And if numbers start improving, which we feel it might and should, I think the next few quarters, Prestige might actually have a steady state show as far as earnings are concerned. And therefore, this is one stock that we are keeping on our watch list and our radars.
Fair point. So, three stocks that we've discussed: Fortis, a new entrant in William O'Neill's Indian portfolio post the RBI rate cut, and two strong defense real estate plays, which is DLF, already a part of global portfolio, and Prestige, given the width that it's moving its businesses in. The one space, Mayuresh, I'd like your view is on stocks from the Anil Ambani group. We've seen our power accelerate dramatically in the last maybe 1 week to 12.5%, in the last 1 month to about 19.5%. Similarly, Reliance Infra, Reliance Home, all of these stocks have appreciated smartly. One, do you have a favorite from this group? If no, what advice would you have for new investors and maybe very aggressive traders?
So one, I think we don't have either an exposure or a coverage on this. And again, I think there are legacy issues, Shelter. I think the whole market probably knows this with this group. And unless there is some definite clarity which comes through in terms of resolutions in either of these companies, the receivable positions on either of these companies, and the contingent liabilities on some of the companies as far as their balance sheet are concerned, I think there has to be an absolute amount of clarity on how all these things are probably going to get addressed. Until that happens, I think there is a lot of buzz and rumors in the market on a lot of things happening with the Anil Ambani group. And therefore, I think we will like to hold our horses as far as this group is concerned. To answer your question, as far as traders are concerned, and aggressive traders at that, who have probably entered the stock, and these stocks have given huge moves over the last few days. My own suggestion is that if you are a trader and going into these stocks with a momentum or a trading perspective, I think it's always better off booking partial profits and keeping a straight stop loss for all the stocks.
Fair point. The other thing that seems to be clicking back into shape, Mayuresh, is IT. Really no view, no growth coming out of Infosys, TCS. Companies growing below India's GDP, I never thought such a day would happen, especially such well-managed, debt-free ones. What's William O'Neill's view on the IT space? How are you tackling this sector?
I think there are phases of cyclicality, and I think our top tier IT companies are going through the phases resonating what the global macro headwinds are. And therefore, I think it's a reflection in terms of the stickiness, in terms of price action not getting reflected completely, specifically in the top tier names as we speak. The other issue, Shelter, is that there is huge competition as far as AI is concerned with global players and including Chinese players. I think we might just be tagged as outsourcing companies. And therefore, I think innovation by all these top tier companies as far as AI is concerned is extremely critical to address, I think, the changing and the dynamic needs as far as the globe is concerned. Having said that, I think a few of the midcap IT companies who are actually catering in terms of this global change and embracing that, a stock like Emphasis, which I've time and again emphasized on, or a stock like a Persistent System, is something where I think the growth dynamics as far as new technologies are concerned, where generative AI is concerned, are actually taking shape quite significantly on their overall book. And therefore, I think as new orders keep on coming in, the confidence that the management is probably exhibiting at this juncture in terms of dollar revenue growth, in terms of consistency, in terms of EBIT margins, in terms of pricing, not being a constraint for these companies at all, including orders, and the orders that they probably cater to 5 million, 1 million, 10 million, 20 million, are absolutely coming in reasonably well, even as we speak, in terms of global macro headwinds. I think the earnings outlook might actually continue. Valuations might be a tad bit on the higher side, but my own sense is that the kind of numbers that they have exhibited and are expected to post might actually give them those premium valuations. So I think Coforge, Emphasis, Persistent from the midcap IT space, in our opinion, can continue.
Okay. And similarly, you see now Persistent climbing back around 6,000 rupees, rallying for the last 4 days. You have a very strong move coming into Coforge post its split. So yes, there are pockets of excellence in a sea of mediocrity as far as IT is concerned. Only midcap is clicking and clicking well. Mayuresh, how are you watching the banking and the NBFC space? These are the two biggest beneficiaries of the rate cut. and we've already seen a very sharp rally in gold finance NBFCs. Both Muthoot and Manappuram are at a record high. How are you watching this space? Any favorites from the NBFC sector?
So with the tweaks that has happened and what RBI regulations have proposed, recommended, at least for the gold financiers, obviously these stocks have responded very well to RBI. RBI's new regulations expected to come in. Below 2.5 lakhs, in fact below 5 lakhs, the LTV obviously increases, which gives gold companies the flexibility to a large extent. And therefore, I think in terms of the norms that have now come through, uh, companies like Muthoot and Manappuram will obviously benefit to a great deal. Obviously, gold prices at elevated levels is something which acts as a deterrent in terms of fresh purchases as far as the gold jewelry companies are concerned. But when it comes to refinancing options, I think what these companies basically benefited from earlier was obviously the lack of liquidity into the system and the stringent norms that were happening specifically for banks. Or other NBFCs, which had to probably adhere to these norms, as well as the gold finance companies themselves, in terms of how do they measure gold, how do they value gold, how do they store gold, etc. But I think with the new regulations, I think it has created a sort of impetus as far as the prices are concerned. Within NBFCs, again, I think the leadership stock shells is somewhere. I think the belief is with the rate cut which has happened, the borrowing mix, because they are better placed and have better credit ratings, will have a great element of upheaval as far as NIMs and spreads are concerned. Because their capital adequacy is strong as well, the expectation in terms of solid growth happening in terms of their advanced profile as well, which is well diversified, should also play out. And therefore, I think leadership NBFCs like a Shriram Finance, which we continue holding in our local and global portfolios, in our opinion, can continue doing well. So NBFCs might have a slight bit of an upper hand as far as the entire BFSI is concerned. Banks shall continue doing well. However, with the rate cuts, the expectation largely again is how will deposit accretion probably happen? And deposit accretion is one of the biggest issues that the sector has probably faced. So this is going to be very interesting in terms of larger banks and the deposit accretion that they probably do over the next few quarters.
Mayuresh, the rally on defense now seems unstoppable. Record highs on BEL, Masgaon, Garden Reach is out of everybody's reach. How do you see these runaway rallies possibly now momentified, if I can use the word, in terms of how momentum has crept into them and taken over the entire thought process? Despite this very sharp run up, do you still feel any defense counter which might offer an opportunity to enter at current levels?
I think a large part of the universe shells has run up earnestly, and they have gone way above the stratosphere. So I think a large part of the defense stocks are trading at expensive valuations as we speak. Obviously, the tailwinds are there. They've got decent order books, giving revenue visibility over the next 4 to 5 years. They are executing decently. The government will ensure that execution happens at a very decent pace going forward as well. And therefore, I think the entire perspective that comes through is apart from the domestic orders, is there an export opportunity that exists around the corner for these companies as well? What Operation Sindoor has proved is that our indigenously developed technologies have not only worked wonderfully well, but they are world-class technologies as well. And therefore, I think a lot of countries in Europe, which are upping their defense budgets, a lot of countries in Southeast Asia, might actually be looking at our companies in terms of export orders. So the tailwinds are there, the earnings visibility is there, they're executing reasonably well. And therefore, I think, does one ignore the valuation aspect altogether and play the momentum? You can absolutely do that. But at this juncture, my own sense is that they've run up a tad bit too much for comfort. You probably need to wait for declines to enter these stocks.
Okay, fair point. Mayuresh, what are you avoiding? Something that hasn't woken up post fourth quarter, something has remained unaffected because despite rate cuts, something that refuses to move within your research universe. What is it that you don't like at all now?
So I think metals and commodities as a space shelter is something where we are still circumspect, and this is largely due to do with the global conditions at play right now. Very difficult to map how global demand supply conditions will play out, how the Chinese economy will come back, whether inflation and growth related headwinds will still have an upper hand as far as demand dynamics are concerned, and therefore pricing as far as LME is concerned to a large extent is something to be watched out for. So I think whether it's ferrous or non-ferrous, I think the entire universe is largely dependent on demand dynamics in terms of pricing, in terms of input costs, and everything probably remains a little bit circumspect at this time and very, very volatile as far as data points are concerned. So I think it's one sector that I'd probably be just not looking at this juncture might be the metal and commodities space, Shils.
Okay. And how are you seeing the global risk on trade at this moment? Mr. Trump refuses to pipe down. Globally, the CDS spreads on American debt are rising.
Yeah.
Japan isn't in great shape. Silver is in top form. Is all this also, aiding India in the sense that FIs might think they are missing a great story? They have been net sellers for at least 18 months, and now you have this rate cut. All these global problems, are they in effect a good mirror for India?
They are. And again, I think if global problems do not go away, again, all the points that you put forth, Shell, sir, in terms of growth dynamics being a little bit soft, inflation still being sticky, which are appropriately getting reflected by the bond yields. You look at the US 30-year, you look at the DAX 30-year, you look at the Japanese yen carry unwinding 30-year bond as well. What you're probably seeing is that the risk that are reflected by the bond markets is something which is getting reflected in terms of how the economy probably fares across the globe. And if these economies do not come back very, very strongly, there is a potential that there might be a sell-off that might actually happen in equities to a certain extent. If you don't have resolutions for tariff policies, as an example. And therefore, I think India is well shielded on all these counts. However, I think because of the global concerns, if we do get a tip in India, and a significant one at that, I think that will prove to be buying opportunities for anyone who's probably missed the rally that we've probably seen in the last few weeks, in the last couple of months. And FIs will then have a look and reposition that which economy is expected to relatively better and fare better compared to the rest of the globe. And therefore, I think FIs, in my opinion, or FPIs don't have much of a choice if they keep on ignoring India.
Mayuresh, my final question to you is on this rally that's sparked in small finance banks post the rate cut. These are of course riskier assets, but see the kind of rally that's coming in a Jeevan Small Finance Bank. Is this a space worth tracking? Do you have a reasonable stock to pick here?
So we'll wait and watch. And it's a very interesting space, Shelter, since you mentioned, because if you probably just divide the buckets for small finance banks, microfinance was clearly struggling over the last few quarters. It is showing some signs of stability. The SME, MSME space was struggling for a plethora of issues. They had some tax-related headwinds that they were facing with, along with expectations in terms of the receivables positions and the slippages and the restructured book portion, which had shot up quite significantly. And last but not the least, I think the unsecured lending portion as well, which was far riskier compared to the secured book that banks and select NBFCs carry. Now, a combination of all these factors actually dragged down earnings to a large extent. But if we come back to my opening remarks, if the expectation is that rural comes back, there is ample liquidity support that is now getting created. A large part of the legacy issues that we've seen in the last 4 to 6 quarters, whether it's microfinance, MSMEs, SMEs, I think they should largely be behind us. But again, I think with the accelerated liquidity into the system, I think the push through that happens for small finance banks is accelerated credit spending and advanced spending as well. So I think if those advances grow at exponential pace without strong credit underwriting as we speak, because all these segments are still recovering as we speak, there might be some element of risk as far as the slippages or the SMA2 or the restructured book is concerned. And therefore, our stance is that they're showing signs of recovery, but let it show some definitive signs in the next quarter or two, and then we'll probably take a call.
Between the time, Mayuresh, we started discussing IT and now, persistent has moved from 5996 to 6017. So, as they say, tiger जिंदा है, ढूंढना पड़ता है टाइगर कौन सा है.
बिल्कुल बिल्कुल.
My one final question to you is on how the rally is shifting towards silver within precious metals. Is gold done and dusted, or will gold have another day?
नहीं सोना चांदी में सोने की भी जीत होगी. Obviously, I think the sheen has come off a tad bit, Shail sir. But my own sense is that the smart investors have actually booked some profits in gold and have invested in silver. So I think that's what the smart investors have done, and they've hedged themselves perfectly well. But I think if the global risks and the uncertainty continues, I think gold should make a very strong comeback.
Okay. Mayuresh, one final question. Have I missed asking something that you wanted to highlight, which you should?
Yeah, I'm not sure. No.
Okay, we'll call it a day. Thank you so much for being with us, Mayuresh. As always, it's such a pleasure listening to your views. And then, of course, we'll keep an eye out on Fortis, which is the latest edition as far as William O'Neill's India portfolio is concerned, post the RBI rate cut, and two standout real estate stocks, which is DLF and Prestige Real Estate. Thank you, Mayuresh. Have a nice day.
Thank you, Shail sir. Always a pleasure to be on your show. Thank you so much for inviting.
With that, ladies and gentlemen, continue watching Business Today Television. There's a lot that's happening on the other side of the break. News continues on BTTV.
समाज के